Welcome to the F Word Finance, and today we're talking about a topic that's probably made popular in Hollywood in the 1990s and 2000s, where every rich guy was either a hedge fund manager or owned a hedge fund firm. So, Waldo, we invited you today. You're from Peregrine Capital. In basic terms, in layman terms, what is a hedge fund?
Okay. Jeepers, let me just introduce Peregrine. You said it's 90s. We were started in 1998, actually in the Asian crisis. And we've been running for 26 years. We're an owner-managed firm. We're not a large shop, to be honest. I think we're about 43 staff members at the moment. And what we aim to achieve, and that's the reason why I started off explaining what Peregrine is we are the third largest investors in our funds. And our funds are there to actually be the best risk-adjusted funds in SA. So that's our goal. So in terms of a hedge fund I think the main objective of it is to create great returns, but to manage downside risk. Also, not sit in a situation where you invest where it feels like your money is on a seesaw, where if you put in 100 Rand, you end up with 120 one month and 80 Rand the next month. So what we do is we've got certain levers, and I think to colloquialize this in more common terms, we can use insurance policies. We can make money when the market goes up as a normal fund, and we can make money when the market goes down. Normal funds can't do that. We're only allowed to do that. So the reason why hedge funds have became popular now in South Africa is legislation actually allowed us to become popular. We weren't allowed for retail investors, and we were the first guys to launch retail investors funds in South Africa. So you can find us via you guys. And before that, it was only for high net worth individuals. And I think that's the thing that Gio mentioned now. You mentioned that it was 90s and 2000s, you've watched Billions, then it's Wolf of Wall Street. Every now and then it's the guys that watch Boiler Room back in the day. But in general, the stigma around hedge funds was guys with yachts, private planes, and guys that did a bit of shady dealings. And that's actually not the thing, is if you compare us to cars, people think we're Lamborghinis or Ferraris. In general, we're more the safe family Volvo. So that's how you use it.
Yeah, that's an interesting analogy. And I think, like you say, most people think it's very risky. I think there were some examples where people did dodgy dealings and then lots of clients lost lots of money. So how risky, or is there a conservative hedge fund and a riskier hedge fund?
Yes, completely. And I think that's usually where the stigma came from, is in the past, hedge funds were long shorts with open-ended, let's say, loss-making potential, where the hedge funds that we offer, and most of the hedge funds in the market you find in South Africa, are regulated. That's the first thing. So in terms of the risk, it isn't throwing your money into a black pool or in a Ponzi scheme or something where an old tiny that you know lost money in. That's not the stigma that we wanted to create. So hedge funds are a safer achievement that we work towards. And how we do that is actually based on first auditing systems. So we actually, what we disclose on our fact sheets are published and audited by us, our Manco, Riskera, and the FSCA. So that's the first thing. Then secondly, as you may ask now, do you get conservative and, let's say, moderate risk hedge funds? Yes, you do. And what we try to achieve there is if you compare it, you say the normal balance fund, I think the average return in the sector, let's call it as 10%. What a hedge fund would do with the same level of risk would be that's multiplied by 1.3. So that's where it kicks in. And then on the conservative side, it's the same thing. So you end up getting absolute inflation-beating returns, but at lower levels of risk. So instead of going higher up in terms of risk to take, so going full equity, you don't have to take as much equity into your portfolio, but you can generate the same level of returns and even better it.
Yeah, I think if we move back to volatility that you just spoke about, and you said decreasing volatility within a fund to get a smoother profile, how does that actually work, and why can't another vanilla fund, a long-only fund, achieve that?
Okay, so we've got more levers. So if you think about this, you've got to get a normal kitchen knife. You can spread butter with it, maybe cut a steak with it. Hedge funds are like a Victorinox Swiss Army knife. You get the corkscrew, you get the bottle opener, you get the screwdriver, and you get the knife sharpener. So what we end up doing is we can make money when the market falls down. So we can make use of short position.
No, short position.
Yes. It's not the short that you wear in summer. It's just a term that we use where you buy a product where you can make money on a share price falling and not just on a share price going up. So in terms of that, you can insure positions. That's the first thing. Then what we can make use of is something that you call options. An option is a right to participate in upside or downside. So on the downside, it's like having an insurance policy. So if you buy your house, you've got home insurance. Hedge funds are allowed to make use of something you call a put option. What we did is in 2020, we bought a put option in the S&P 500, and when the market fell, we were insured on that day. So we don't participate as much on the downside. So that's the insurance that I'm referring to. Something more recent, and I think this is something that everybody in SA experienced, was with the GNU negotiations, everything went well. We're like, okay, cool. Yeah. That was amazing. Market went up. What would have happened if that didn't happen? Let's say it was a doomsday coalition. So what we did is we actually had a put option on the rand there. What that works towards is it's an insurance for, let's say, MKEFF and the ANC actually grouped together and the rand blew out to 25 rand. We would have participated in the rand losses there, which means we paid a premium and we were insured when the market fell. That's the first thing. But obviously that didn't happen, so we only paid away the premium. So it's your insurance that you didn't use. That's the first thing. Then what we also did is we had a call option after that. A call option is a right to participate in any upside. So we paid a premium, and when the market went up, we participated there. So we didn't have to go and stock pick 5 shares that went up. When the market went up, we participated there. So that's the different tools that what we've got.
Yeah, and I like the analogy of the knife versus the Victorinox, but in all honesty, we know a Victorinox costs a little bit more. So maybe let's just explain the fees, because if you do see the fund fact sheet, it is more expensive than your normal fund. How do you think about the fees, and you still outperform the other funds net of fees?
Yeah, so look, that's also something that's been driven for the last 10 years where it's been passive and actively managed passive funds with lower TERs. A lot of clients have been pushed towards that, and I think you guys know this in the market, in my history as well. Platforms were put under pressure, advisors have been put under pressure with fees, and now hedge funds are coming to the party. It's this new hot we're making it fetch, as they would say in Mean Girls, but the thing is we're about 10 times the fees. Sometimes we're not. And where does it come from? So our management fees are a bit higher, but that's a structured fee where there's a lot of input that needs to be made there. But if you have a look through the fund fact sheet, something that it actually attributes quite not enormously, but a large percentage towards the TRC of the fund is transaction costs. Transaction costs is us participating in buying and selling shares in the market. It's a big thing. We're small and nimble enough to still do it. And it's actually a good thing for the market because hedge funds actually create liquidity in the market. So we put shares back in the market and buy shares that are out there. That's something the normal funds don't do. It's just an add-on in terms of that. Secondly, as I just mentioned, those put options and call options, the shorts that we can do, those things cost money. That gets put in there. And as mentioned, we also invested in those funds, so we pay that together with our clients. And then the one component that's variable that can make the fund expensive is performance fees. So performance fees is the right to participate and pay yourself when the fund's value go up. It's the easiest way of explaining it. So every quarter, we see if the net asset value of the fund goes up. Net asset value is, if I had 100 Rand and next quarter it's 105 Rand, we're allowed to pay ourselves on the 5 Rand that it went up. If it goes down and the 100 Rand went down to 95, we're not allowed to pay ourselves. That's the easiest way of explaining it. So it's a bit counterintuitive in terms of what was mentioned in the market, where you sit in a situation where if the hedge funds are expensive, you know we're doing our job. If we're cheap, you should fire us because we're not doing our job.
Yeah, and I don't think people mind paying fees if you're performing. I think that's where performance fees comes in, because that actually means you're reaching or overreaching your goal.
Yeah, I think if you look at net of fees, because people do look, they just look at fees these days and say, well, listen, okay, well, why must I pay more? Well, at the end of the day, you get more. You get more protection from a hedge fund, those type of things. So fees are important, but they shouldn't be the only...
should be value.
Yeah.
What's the value you are getting? So how would you say does a hedge fund fit into your portfolio? What percentage should it be, and for who is a hedge fund?
Okay, so I think when it comes to inclusion principle, somebody that actually is the godfather of modern portfolio theory is Harry Markowitz. He says the only free thing a guy can get in there is diversification. Mm-hmm. So diversification is a nice thing, and when you plug in hedge funds, I think in terms of percentages where you were touching on, is anything between 10 and 20%. That's where it goes. Who can access it? Everybody. I'm invested in our hedge funds. My mom is, my wife is. My mother-in-law is still on the fence, but she's getting in there as well.
They're always tough, the mother-in-laws.
Yeah, sometimes you want to put them in the competitors' money, the funds that they lose a bit. But the main thing there is you sit in a situation where if you've got a product, barring tax-free investments, where you're not allowed to charge performance fees, you can enter it. So pre-retirement money or preservation funds, retirement annuities, that's governed by Reg 28. I don't want to get into too deeply there. Then living annuities, and obviously discretionary money, and if you've got trusts via the endowment route. So you can access this everywhere.
Yeah, maybe if we can just take that back. A living annuity, obviously, can you just explain to the people out there what a living annuity is? And then also somebody that has money in the bank in a money market account, that's a 7-day money market account, can they take that money out of there, invest it with you guys? What type of vehicles can you use?
Okay, so living annuity is quite simple. Is when you retire, your provident fund post 55 goes into a living annuity and you draw income there. So you can use us there. Francois, in terms of your question with the 7-day money market or notice account, you're sitting in a situation there where yields look nice. And look, this isn't a sales pitch. I think the main thing is just be aware and speak to your advisors here that after tax, what's being quoted and what you get isn't always the same thing. What you end up with if you move the hedge fund direction, like our more conservative option, the pure hedge, is 85% of that fund's capital of nature. So the growth ratio that you see there is a lot higher in terms of participation, and you actually only see tax at the moment when you exit the fund because some of that's dividend income as well.
Yeah.
It's a good avenue to explore and to actually move away to where you're basically only tracking headline inflation and not keeping up with what's possible for yourself. The other problem is let's face it, if you've got a trust with 5 million rand in the bank, they're paying 45% tax on that. So your 10% becomes basically 5.5%.
Yeah.
So that's not a good avenue. You're actually the Afrikaans of your boer agter uit. That's a big thing there is you need to find avenues where you almost have the same level of risk or volatility as mentioned, but you're gaining about 5 to 6% above that. And that's what the hedge funds offer. We're allowed to make use of the right tools, as we've mentioned with a knife, where we can say, let's lower the risk of the portfolio, but you're actually getting a lot more yield.
Yeah, that's brilliant. So basically in that case where you just said you've got 5 million rand, let's say that 5 million rand is invested with Peregrine, how would that sort of look like? Because now you've got 5.5% in the money market that you're actually getting out. What would that sort of look like in the pure hedge fund?
So a pure hedge fund, like I'm going to lie if I try and quote the return figures, but what we aim to achieve there is between 11 and 13% over a rolling basis, and we do. So if you think about that, if you only pay tax on 5% there, you're still achieving double-digit returns even after you're in the platform fees.
Yeah.
So the client would end up receiving between 10 and 10.8%, even a bit more depending on how the market works and how the fund's position. But you're still seeing double-digit, which in absolute terms is inflation plus 4 at least.
Yeah.
So that's moving forward. That's a goal actually that wants to be achieved by a balance fund at the moment.
Yep. Waldo, one question that I always get is there any scenario where an investor can lose all of his or her capital? Because we see all these movies, and actually it's not just in the movies, it happens in the States where they take a very risky position, they leverage themselves, and then they end up going broke. So is there a situation where this could happen within one of your funds?
Okay, Francois, I think to answer that is, let's move into legislation first. Because we are FSCA approved, the FSCA, we're a registered financial service provider, what we publish is something that, there's lots of strenuous auditing that goes into it before you enter that situation. So bear in mind this. So a lot of guys that lose all their money end up doing what? They throw everything into risky positions because the upside is 5 times.
Yeah.
So the funds gear themselves.
Yeah.
In South Africa's situation, that's actually not the scenario. So the fund, like as I mentioned with Markowitz, is diversified. If you look at our common goals, or not common goals, but if you look at our holdings, we are at the moment 67% equity, and that's not on one equity, that's actually split about, let's say, 20 or more. We've got foreign bonds, US and UK bonds. So if you think about that, if anything goes bust, it's not related to each other. So that's the big thing. It's a way of proper portfolio management. The one thing that I know can be scary with hedge funds is people think, yeah, anybody who was a student or whatever sees a GT24/7 account, or way back, you can take some fictitious money and then you can gear yourself 1 to 3 exposure. Yeah. And people think they do that in hedge funds. We don't do that. So we don't gear. It's a big thing to remember is we don't take unnecessary risk. We actually use the right tools to lower the risk. And that's the big thing because we don't want capital loss. A good example here is our pure hedge fund is our first one. It's 26 years old. It's never had a negative calendar year.
Yeah.
So if you work around that, and that fund was started in the Asian crisis, the market took a big bath there and the fund actually performed quite well.
Yeah, no, thank you, Waldo. I think that puts some clarity into what a hedge fund is. And I must say, if you look at your performance, you guys have done well. So people out there are welcome to just go and see, look at the funds and ask us any questions if you do have, where it fits into your portfolio, how can you use it as a diversification tool. And yeah, it's a lot more accessible than it used to be. It's not just for the guys in billions and in Hollywood. So no, thank you very much, and we get soon.